Good morning, and today on the show, while it's not so glamorous, we're going to be talking about the plumbing of the options market. So we're going to look under the sink, little market structure, clearing, the OCC, and price marking. And all this is coming around because of some of the newer entrants into the market that might not look like your typical space. Let's get into that after the bell. Well, I'll be damned. Good to see you, boys.
Howdy.
Hey, Lex, how you doing?
Good. How are you? Good to see everybody today. You know what we're going to do? We're going to run through the markets real quick, change of pace. And we're going to give the reason why I'm wearing the red hat today, because gold is down. I'm seeing gold down 25. Oil up 7.74, 95-ish a barrel. Nasdaq's down 267, S&Ps are down 62, Dow Jones down 500, 493, and the VIX is up a measly 1.82 to 26. Thoughts, comments, anything exciting, outstanding stand out there at all? Probably not.
It's all the headlines are scary right now, but from Volin's standpoint, the options market's very supportive. So.
Yeah, agree with that. Boy, I'll tell you, it's been fun to trade, that's for sure. Anyway, the red hat down day. I actually have a green hat, one of these too. I didn't even think about that. Hello. Okay, let's talk market structure. We're going to take a peek under the sink today. First thing I'll say, Mark, I'm going to let you kind of tee this up a little bit because I think it's something that you were thinking about. But I'd like to just start out by saying, these aren't the fun parts of the business, I don't think. And I threw in regulatory, SEC, FINRA, that sort of. We could talk a little bit about that. But, market structure, clearing, the OCC, price marking. And Mark, you had an interesting take, which we can really chat about, is now that we have Kalshi and Poly market, entering the space, and we have prediction markets. It's a little more on the future side of things, I would imagine. But that all of a sudden leads into an interesting conversation of, how is that going to be regulated? FanDuel, DraftKings really is regulated, but it's done a different way, et cetera, et cetera. So things could kind of change a little bit to let these people introduce their products into the marketplace, right?
Yeah, exactly. Like, I think that's what brings up this, what really is a perennial conversation for listed markets. But that's what brings it up today, is that we have, exactly like you say, the Kalshis and Poly markets of the world that are listing things that basically look a lot like an equity option. If you pull up Poly market today, you can bet on where the S&P is going to close at noon today. So they even have types of options that aren't even listed on the CBOE or MIAX.
Right. So these are typically called, in the old days, why do I always talk about the old days? Because I'm old. Probably pretty much. They used to call them binaries, right? If I'm not mistaken. Is that accurate?
Yep. The payout structure looks very much like a prediction market or a binary option, that it's priced somewhere between $0 and $1, 0 and 100, and you pay, a premium. And if it hits, it's $1 payout or $100 payout. And if it misses, then it's a $0 payout. So yeah, they look like a binary.
But you can technically go the opposite way and bet the no, right? Which is kind of like shorting it in a way.
Correct.
So, okay, So you can bet yes or no, and then you have two choices. You can bet yes or no. There's no middle ground, right? And it doesn't add up to $100 or $1, let's say. It's a little bit more than that, I've noticed, and I'm assuming that's the commission or the vig that the space gets. I don't know if it's market maker or clearing agent or what. So is that accurate as well?
Yeah, I believe there are no market makers on these. Traditionally, it's mano a mano, which is, kind of one of their flaws, or one of the weak points, I should say. It doesn't necessarily bolster liquidity. Some of these are pretty low, volume traded. But yeah, if you add up the yes bet and the no bet, it's going to be something like $1, $2. So the exchange, the clearer, they're one and the same really, and they're taking a nice vig off the top.
Doesn't it add up to like 99 cents, 98 cents?
The ones I saw the other day, and I'm going to bring it up in a second here. The one I was looking at, this is because, and I'll say why also, that it added up to, I thought it added up to 104, but maybe it was 95.
Yeah, what I see on IBKR, they really promote the heck out of these things. I guess because every single time there's a new one on there, there's like some juice, I guess. I don't know what you call that, commission. But it kind of plays like juice, like if you're betting like a sport game, and you add up the win totals on both sides, you come to less than a payout.
Well, isn't that a lock then? If you buy two yeses or a yes and a no on an event, then you're guaranteed to win, right?
If it's over, but if it's like 95 cents, then you buy yes and no, then you're losing. And that 5 cents goes to whoever.
Yeah, that could be right.
I think that's the way it goes. Yeah.
I'm looking it up now. I'm trying to get on Kalshi. I don't have an account yet.
Right, but you're guaranteed to get a payout of $1 on one or the other, and you only paid 95 cents for that.
If you pay, hold on.
Wow, we're confusing ourselves.
Yes, we are.
If you buy a yes, it's either
the payout is $1.10. Yes, and the percentages that are on there come out as less than $1. You're right, Mark.
I've been fooled once or twice. I navigated my way around crypto. I know how to get fooled by spurious new investment contracts or pseudo investment contracts.
I love it. All right, so this new marketplace. All right, interestingly, how is it going to? Is it going to be regulated? Is it already regulated? And I'm kind of moving more toward not the sports betting part of it. Let's say the financial markets part of it. And I'm not sure it matters, quite frankly, but let's talk about the markets part, because that's what we do, and we're so used to regulation with SEC FINRA. Now, are they going to stick their nose in this thing? I know it kind of hits the future space more than anything, right? It's technically a futures, swaps, or whatever they want to call it, if I'm not mistaken. Any thoughts on that?
Yep, this is CFTC regulated, and that was kind of the watershed case that Kalshi won, suing the CFTC for basically to ask to be regulated. And I believe they won that sometime in like September or October, because that's when you saw that like flood of election contracts come last year. And that as soon as Kalshi won it, you saw Robinhood, you saw Interactive Brokers, everyone kind of jumping on the train of prediction markets that are all CFTC regulated right now. So Kalshi is, but Polymarket is based somewhere offshore. I forget exactly. And because that's kind of more on the crypto side of things, they are not currently regulated.
Okay. Interesting. But these things, what are your thoughts though? Are they really gonna, they have to be regulated eventually, right? By the same agencies that regulate our business, or no?
Well, I mean, I
heard about Polymarket too.
Some of them would have to be regulated by gambling commissions, because something like, is Taylor Swift going to be pregnant by the end of the year? You have to define how do you know when she's pregnant? Is it when she announces it? Is it when this and that?
Yeah.
And there was already like some issues of, will there be a nuclear detonation in June or something like that? And they're like, does that count as a test? If they do a test, does that count? Does this, all that kind of stuff. So I think like a lot of definition problems in these prediction markets.
Right.
I think that's exactly it, right? Like that we've worked so long in listed markets to produce, very strict and regulated definitions about what an option is expiring and what the corporate action breakdown is going to be and all those specific rules. And like the reward for that is liquidity. If there's uncertainty around like how something's going to be defined or how something is going to pay out, like you aren't going to see dollar volumes. Like a lot of these, Polymarket and Kalshi markets, you're seeing, 50 grand trade on them. And like, that's not either an accurate indicator or a place to really put any meaningful kind of trade on.
Right. I read an article a while back by our friend Chris. I won't say his last name to because he probably wouldn't want me to. You know who I'm talking about. But he wrote he actually didn't write this piece, but he directed in his piece to a video, and I think it was done by someone from Susquehanna, one of the poker players at Susquehanna, and it was talking about how really very good these predictive markets are at predicting what they're predicting. They're amazing in how accurate they are, which I find kind of, I guess it's maybe obvious, I suppose, because they're playing a book, right? Just like any in Vegas, right? I don't think the house is trying to necessarily win the yeses or win the nos. They're trying to make the vig in between, right? And have their book balancing up so that they can't lose. Does that sound about right?
Well, they can't lose either way. I mean, like if you're betting on a sports game, somebody has to make that initial spread. Here, the spread is made by the dollars going back and forth.
Yeah, but Susquehanna's involved in this game right now. They are making. I'm going to say making a market, but they're doing something with how those numbers are tallied. And if you look at hurricane insurance, and knowing whether or not a hurricane, I think some of these insurance companies are now using these predictive markets kind of intelligently to kind of adjust their premiums based on events. I even looked at one the other day. I'm from Chicago, as you guys know. I'm a Bears fan, as you also know. I'm a frustrated Bears fan, as every Bears fan is. And there's this talk about the Bears leaving the city to go to another venue and build a stadium. Well, one of the stadiums is near my house out in Arlington Heights, right? It would be like a one-stop train ride for me, or a 10, 15-minute ride, which would be great for us. And it's more east toward the city. The other one is in Indiana. That just came up. So I looked at the Polymarket call sheet. What's the probability, or what's the market on the Bears leaving Chicago? Okay. And it had 3 choices: leave Chicago for Arlington Heights, leave Illinois for Indiana, and then stay in the city. All right. It was like 70%, 70 yes to stay in Illinois, which means not go to Indiana. And people are thinking, oh, Indiana is going to happen. And, it's a done deal. The market's not saying that at all, right? I'm eager to see how it plays out. So, obviously there's so much information. And as you said, buying and selling, and the market kind of finds its natural equilibrium based on the pressure it gets in these predictive markets is very interesting, I think. So where does theoretical value lie, in the market?
Yeah.
Yeah, absolutely. And I think I totally agree with the idea that there is a lot of information. I think the caveat that I put to that, though, is that you have to be able to use that information correctly, and that it requires a little bit more of like an analysis of what the flow might have been, right? Because a big whale coming into these markets, if they're relatively thin, that can really push things one way or the other in the way that it wouldn't necessarily in a traditional securities market. So while there is really accurate pricing, it's something to lean on vis-a-vis even intraday equity options pricing, could be informative about that, or it could be informative about that. But they are still prone to liquidity vacuums and outsized trades, blowing through order book levels.
Yep. For sure. I totally agree with that. And I like the way you can see the total amount bet in any given prediction market. I think it says total somewhere in there. And I'm assuming that's a total bet on this event. I'm guessing that's what that is, right? It's, it does vary. You get sometimes 50,000, you sometimes get millions, it just depends on what it is. So that's pretty interesting as well. I guess it's a thumbnail of liquidity, maybe. Could be.
Yeah. And look how accurate they were in the presidential elections. I forget the exact details, but I think not only in predicting the final result, but also down to a state level, it was more accurate than any of the individual polls.
Right. That's why I like it so much. I find it fascinating. If I need to know probability of something happening, I'll go there like instantly, get a feel. I really like that. Now, do you guys think, though, let's talk about the option side of this, or the financial part of predictive. Will it become another FanDuel for younger folks who like to play, sports and put it in the financial aspect? Let's say Amazon has earnings. Is it going to become the kind of that, gambling sort of ideal, or do you see it ever becoming sort of a hedge of sorts, where you could actually hedge your opinion in the options market with a prediction market on a yes/no kind of basis. Technically, you could win on both. I think, if you think about it, right? There's a chance you could win on both. Think about it. Will Amazon beat earnings? Yes or no? Great. Well, you could make the bet that you sold premium over on Amazon, that it's going to, kind of stay within the guardrails, and you could pick it's going to beat earnings and it's still going to stay within the guardrails. And you make on both, right?
What you just said is why it won't be used as a hedge.
Okay,
because
good.
Not only can you win both, but you could also lose both.
You could, for sure. 100%.
What is the correlation between will Amazon get their earnings and the market move? Because a lot of times that doesn't necessarily correlate.
Right. But you could also hedge it straight up, meaning sell the call spread, right? Will Amazon beat earnings? Yes, which would cause the stock most likely to go up. I mean, I know in cases it doesn't, but it could, in which case you kind of hedge some of that call spread risk. And where it could help you is if they beat earnings and your call spread's far enough out of the money and it doesn't push the short, you win on the bet at beat earnings, and you also win on the call spread. That's another example of how you could do both.
Or they don't beat earnings and you lose on the call spread also because some other variable like cloud computing revenue or something like that comes in.
Causes it to like just skyrocket.
Yeah. And so it goes up, or like they announce a buyback even though they didn't beat earnings. So then you lose on both. So I think when you're hedging, you want to be hedged as close to correlated, assets as you possibly can.
Right.
I don't know, Mark, you tell me, what do you think?
No, I very much agree with that. I think, first of all, the cat's out of the bag with the financialization of all this stuff, right? Like, we are going to be able to bet on anything. It will happen in your brokerage account. It'll be cross-margined with your Taylor Swift bets and your S&P 500 zero DTEs. Like, those are all going to be in one big soup together. Like, that's, basically inevitable at this point. And so when you take, all these different securities, of course, they can be used as a hedge against each other in theory. They can also be bad hedges against each other. Or they can be good hedges or imprecise hedges. So, I actually think the best use case for sports gambling is to bet against your own team as an emotional hedge.
I love doing that. So what about the FanDuel, DraftKings of the world who are regulated at the state level? You can't place a bet in some states and you can in others. Whereas in the prediction markets, I'm going to be able to put it in my brokerage account no matter where the heck I am in the country or world. Is that accurate? How is that fair, I guess, the way to say it? And does FanDuel, DraftKings kind of saddle up with an exchange of sorts and make its offering something like a prediction market all of a sudden?
It's a good point. I don't know.
Sort of what Robinhood is doing, right? Like, you can bet on the NFL with your Robinhood account right now.
But that's not done through FanDuel and DraftKings, right? It's done through Kalshi and Polymarket, or Kalshi.
No, it's done through Robinhood Inc. That Robinhood's the other side of that, or not the other side of it. They're the clearing and exchange, and
who makes the market?
The full plumbing.
Who makes the market? Guy. The Robinhood does, or are they just kind of they're like the OCC? What a lead in! Oh my God, they're like the OCC. In terms
they're
of
like the exchange and the OCC, and there are no market makers. There are only customers.
Interesting. Okay, cool.
I mean, market makers like that might be registered like a Susquehanna or whatever might absolutely be dealing. Like, there are definitely professionals that are wading in those waters, but there's no designated participant with exclusive rights and obligations to provide liquidity.
No GPM, no LMM.
Nope.
Interesting. No payment for order flow.
No OTPs.
All right. Let's move along. I'm really fascinated by this, by the way, and I'm not sure. I will absolutely be a part of the event space when it comes to the brokerage side, my brokerage side. So I just know I am. I'm just a glutton for punishment. I just love doing those things. And it's also very helpful, as I said, in certain parts. Let's go to some of the market structure things. You guys have any thoughts on, I think we're getting 21 exchanges. I'm talking about classic exchanges like a Cboe, MIAX. I think there's a couple new ones. Anything different? Any wrinkles that you're finding with some of these new places, or in the market structure at all? Any comments on that? that you have? Or you're thinking
I'm
about?
old enough to remember when exchange proliferation was considered a bad thing and everyone was up in arms about exchanges 8, 9, and oh my God, look how many we have here. Now it's just a customer offering. And like with the technology, the slight nuances in, whether it's an IEX coming out with, some kind of timing mechanism, or
Yeah.
whether it's like a customer forward model, or whether it's a, dealer focused liquidity provision model, all of these do serve a market segment. And I think, the industry is tough enough that if the money isn't there for the exchange, they have every incentive to, wind it down. And they so far have not.
No, and quite frankly, relative to exchanges versus true market making entities, there are more exchanges than market making entities in the option space today. And I know I'm not exactly right on this. It's either 20 or 21. IEX is going to make the 21st or the 20th. I can't remember. And then I want to say there's maybe 12, branded major market making entities in the space, if I'm not mistaken. Could be 13 now. There might be another entrant coming soon too. So that's amazing where this has evolved to, right? From Mark, when you were there, and then I was there a lot longer, or a lot sooner, I guess. It's really changed a good bit, right? Insane.
Oh, you had hundreds of people literally just in one pit on the SIBO, and there was only the SIBO and the Amex and the Phillips and the PSE.
And no multiple listing.
Right.
So that's all changed. That's structure.
You want to trade Dell, you go to Philadelphia.
Right. Exactly right. So that's a big change as well. Anything that you can see, any headwinds that you guys can see relative to market structure that we're missing, stuff that's not there yet that, just based on X, Y, or Z could cause something to happen. And I hope you say something like, oh yeah, guess what? Pattern day trading is going to disappear, because I think it will someday. And at least it's going to be mitigated, which is the dumbest rule I've ever heard of in my life. But more on that in a second, unless you have something else. Anything?
I would be generally interested in what. Oh, sorry. Go ahead, Jason.
No, I said I could go through all the frustrations we have when with Volland and getting in every trade. I hate late trades. I wish late trades weren't a thing. They're the worst. Also, canceled trades. I don't know how that happens. Maybe you guys could tell me this. How is a trade executed and then canceled? How do you do that trick? Can Tradier do that for me? If I put on a trade and I don't like it, can I cancel it?
No,
they're probably obvious error busts would be my guess.
That's the only thing I could. Yeah, that's the only thing I can think of is that there's an obvious error, and quite frankly, I believe one of the exchanges near and dear has that obvious error protection. What is it called again, Mark? I forget the name of it. It's called.
It might be just that obvious error protection.
Yeah, obvious or something market protection. So anyway, what it does is here's an example for folks, and hopefully this makes sense. If you get triggered on a stop order, okay, and your system says, okay, the price is right, I'm going to send the stop out, but we have a Trump tweet or we have a bomb dropped or something happens and the markets go wide, $100 wide, $1,000 wide. And you have a market order in as a user. And guess where you get filled? At infinity, some awful number that's just terrible. Well, if you're doing that as a spread, okay, what obvious error could do, and I'm just going to give a very basic example. Let's say you are short a $5 wide put spread and you get triggered and you send out a market order. What it's going to prevent you from doing is paying more than $5 for sure. Okay, right. That's number one. So you can't pay $100 for a $5 put spread. That to me makes sense. That's fair. Any complaints about that, guys? First of all,
no,
fair enough, right? That seems
market's thinking.
That seems protective to the retail person, because I think the retail person is the only one getting hurt there, the customer on that one. And it's happened, by the way, until some of this obvious error is put in. And Mark, you're thinking. I think you're stewing over there.
No, not at all. I mean, I 100% agree with you on the obvious error. I mean, I think things like that are counterproductive to liquidity providing, right? Like they're counterproductive to the health of markets, right? Like if you're going to ding a customer on what we generally agree is an obvious error, then that customer is not going to come back. And that's not good for markets in general. And so whether it's kind of rules like that surrounding the market structure, or on the flip side of things, my answer to your question about innovation is I'm excited to see what IEX does with, introducing their kind of delay factor, because on the market maker side of things, pickoff flow isn't necessarily conducive to liquidity in tighter markets. That to the extent that you are eliminating flow that is arbitrarily defined as toxic, and there's a bunch of asterisks and discussion around like what that means, but like flow that is bad for customers or categorically bad for market makers isn't good for the markets, which isn't good for anyone.
I agree with that. I think that's well said. So anyhow, I think we're going to see more of that obvious error thing, and you could structure this in many ways, right? You could even use theoretical value, right? How can someone pay $100 for an option that has been trading around $1 for the last whatever n number of minutes, hours, seconds, whatever you decide? But it's very, and with the same, and you still have access to the stock price, the underlying price, so it's very computable, right? In instant time, practically. So there's many swaths we could use, but I hope they figure that one out, because it can be disasters. I think. All right, we're getting late here, so let's talk about the OCC. Not many people understand that little gizmo, right? Anyone want to jump into that, or you want me to tickle it? It's the options. It's the options.
Your dad made it.
Yeah. So I was on ChatGPT.
Talk about it.
I was on ChatGPT looking at it, and Mark threw that OCC thing out, and that started back in 1973. And you are right. My dad was the original chairman of that, and was there for 43 years before he retired. So he was the longest running chairman in this industry, I think. But what that did, okay, and it had an important function, because in the old Wild Wild West days, Mark and I would trade, and I trade with Jason, and Mark would trade with Jason, and we'd have all these trades, and there's counterparty risk, meaning if I blew up and you had a trade with me, Mark, guess what? You might not get delivered on. And the government said, and the regulator said, and the OCC said, that's a problem. So we need a guarantor. And what OCC essentially did is that if I traded with Mark, okay, I really didn't trade with Mark, I traded with OCC. So let's say I buy an option from Mark and Mark sells it to me. I'm buying it from OCC, Mark is selling it to OCC, and then OCC, along with all the other clear firms, has a process, a clearing process that matches the buyers and sellers. And they do it systematically now. And that same mechanism has been in place since the beginning, since 1973. Now it's clearly gotten more sophisticated, right? And also with early exercise and assignments, or at expiration when you get assigned, it goes through that OCC mechanism, and there's now a wheel, right? And it's my term, the wheel. I think they refer to it as the wheel. And all the shorts and all the longs are placed there. And when you get assigned, it's a random wheel of sorts, and you get hit and you get assigned. Now, a long time ago, used to be in a clump on the wheel. So if you got hit at the beginning and it ratcheted around, you would get hit on all yours, and then someone would escape on it. We used to play dividend plays all the time. And now what they did because of that is they started spacing you all over the wheel. If you had 100 contracts, all your 100 weren't in a row. You maybe get 5 here, 7 here, 9 here, until your 100 added up all around the wheel. So you couldn't have that mechanism of getting assigned, in a swoosh, right? So it's an important mechanism. OCC almost went under it wasn't the 87 crash. It might have been the 89. I can't remember. It was with United Airlines, 92. Someone had sold a bunch of puts in United Airlines. That firm went out of business. And everyone's like, who's making that good? Well, OCC ultimately made good with all its clearing members, right? And in that time, OCC was like a utility. The exchange owned them, which they still do, and the exchanges did. And OCC was a not-for-profit, meaning it collected clearing fees. Once it paid out all its expenses, it would give the money back to the exchanges and the members, the clearing members, whoever they were. Well, when that catastrophe happened, and they didn't have enough money in a catastrophe like that, they said, and I think it was probably part of my dad's doing way back when, this is probably in the early 90s, they said, guess what? Not only are we collecting the commissions, we're not giving you back everything. We're going to keep a fund and create a clearing fund. Now, that fund back in the day was probably in the $10 million range. I'm sure it's hundreds and hundreds of millions now, is where it is. So that fund is there for the rainy day in case something catastrophic could happen with guarantor sort of thing. So in essence, OCC has sort of become, my word, too big to fail in a way, I think. I mean, it has to be in place, and hence it is almost feels like a government body of sorts nowadays. I don't know.
Yeah, I believe in the Great Financial Crisis, it was designated as a systemically important financial market utility.
It was, yes, that is accurate. So,
well, the model is also multi-level, right? Like you kind of hinted at it, but there's the banks and the clearing companies, the Merrill Lynch's, the Goldmans, of the world are members of the OCC, and they act as a first level backstop before things even get up to the OCC level. That's correct.
And what that means is that a clearing member, has to post margin with OCC, and there's a number to be a member that you need first of all, and I don't remember what it used to be. I thought it was 15 million. I could be off on that. I forget. But you have to post that number to be a clearing member. And then beyond that, a firm like, Merrill Lynch, if they're trading a lot of options, they have to post margin at OCC. OCC has a margin process that you have to post margin, to manage your position. So you're right. Those clearing members are the first lines of defense. Whoever's clearing them, OCC, their money's up first, right? So, and there's all kinds of safety checks and solvency checks all the time on that. And that's that whole margin process that exists at the OCC level and exists at your clearing firm level. You got a double kind of protection there, right? Of sorts. So isn't that fun, kids?
Fascinating. I love this type of stuff.
I actually do too. I find it fascinating too. I mean, the U.S. markets are very well structured, I think. I really think
that's why they're the most liquid and tradable in the world. That's like the backbone of why people come and trade here is because you can trust it.
Yep, 100%. And I always tell the retail folks I deal with and I talk to, during the week, they ask me about certain stocks and this, that, and the other thing. I mean, my first look is always liquidity. I just need to know that I can get in and get out without being hung to dry, right? That's a big deal to me. That's one of the more important things in my trading process, I'd say. So just me. But all right, any last thoughts? We gotta go. Good show, guys.
I'm good.
Oh, how about an announcement? Let's go. Jason, you first.
An announcement?
Well, like a little blurb on you and Adayam and Volin.
Like a promo. Okay.
Plugs. I was
about to say, I didn't realize this was known yet. But anyway, okay. Vol.land for accurate dealer positioning.
Okay. That's it?
Okay, fine. Adayam funds as a RIA for controlling your risk with options. And I don't think I'm allowed to talk about my hedge fund.
All right. Don't do that then. Mark, what do you got?
Check out the Till today. I'm writing about the battle between the art and science of trading.
Ooh, I like it. Very good. Awesome. That's harvestedfinancial.com, right?
Yep.
Perfect. And then for us, my big announcement is we are on for the live summit. So all you folks who are out there watching, if you want to come meet all of us in person, we're going to be in Palm Beach, Florida, May 7th and 8th. It is official. You will be getting information in the email soon. And if you don't, make sure you sign up for hub.tradier.com to get that information. It's going to be great. We're going to have a lot of folks from the SIBO. These two guys are going to be there. I'm going to be hosting tons of great speakers and panels. It's a one-day event, man. It's going to be a beautiful PGA National in West Palm Beach Gardens. So that's May 7th and 8th. Spots are limited, so they're going to go fast. Make sure you sign up, and you will get to see us there. We got all kinds of fun gifts, too. It'll be a blast. All good, guys?
All good.
All right. Good to see
trading.
You. That's a wrap. Happy trading.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.